I have added a few resources which you might want to use and a few lists of investors and syndicates that, again, you might want to use as you're preparing. So don't worry about it. There is a practical element, but that will come in your inbox after the workshop.
Yes, and also we are planning to continue these interactions also in one-to-ones. So first we want you to get through the big picture of
Yeah,
what
yeah,
each person
yeah.
this. So Flavia will surprise you with some invitations also in the next month, so you can get to
Yeah.
specifics.
Yeah, amazing, amazing. Well, guys, look, I think it's, I'm here to help. I've worked with companies over the years. I'm on board of a few companies now and heading into my next role, looking at a new fund with Velocity. So very exciting part of the journey. I've been there, I've done that. I understand the struggles more than you guys perhaps can ascertain at this stage. So I'm really here just to help give you a bit of guidance. I'll start with the market. Last year obviously has been very tricky, mainly because as we went into lockdown, you would have seen that many of the investors have started to look at their portfolio. So there was kind of this dip of investment in new companies, but the story didn't play exactly like that. So a lot of capital rushed in from various different sources, including the European Investment Fund and many others. And the ecosystem has recovered and actually excelled previous year performance. So in 2020, over 40 billion have been channeled into the European venture capital companies. Vast majority of it at the sort of a later stage. So these are companies beyond kind of Series B. But putting things into context, half of it has gone into very early stage, so angel seed and early kind of Series A, Series Bs. So quite a good chunk of capital has actually gone into growth, which is really reassuring. And about, probably 5% of that 40 billion has gone into first-time investments across the continent. So putting things in perspective, we're at a point in our ecosystems, and I do realize that there's some differences depending on the country where you find yourself, where we have just so much capital that we've never had before. So right now at a European level, there are about 800 funds addressing various different parts of the cycle, from very early stage until late stages. And they're quite a good chunk, about half of them addressing exactly the early stage bracket. So investing in rounds like seed and Series A. So that's a very important element. If you're thinking about, is this a good market to go and fundraise? It has never been better. And with many governments and of course the European Investment Fund and many other similar organizations announcing their intention to back more VC funds, the expectation is that we're going to end up in a position where every single country will have 20, 30 funds addressing them pretty well. Out of this 40 billion, one of the things that will become quite apparent to you guys is that almost half of these investments are actually still happening in the UK. Vast majority of funds have a residency in the UK market due to the regulatory system. So last year, about 17 billion have been invested through the UK. Vast majority of them, of course, for London. So definitely bearing in mind the prediction for the UK this year, as we kind of reach the 10 billion point in June, is that we're going to have around kind of 28 billion. So the role of the UK market, though not in the EU anymore, it's still one of importance, especially if you're thinking about your Series A, there are a lot of resident funds, and as you can see, a lot of capital has been raised and is about to be channeled. So definitely consider a more kind of European or even global strategy as you're going out there and thinking about your strategy the same way as you would be thinking about your sales approach or go to market. Definitely have a strategy for your investment. In terms of angel and seed, as you can see, around kind of I would say 5% have been invested at this very early stage. So it's definitely a very, very positive message from investors. It just gives you a sense that everybody is looking at innovation and at technology growth companies as an investment strategy. So more and more capital is positioned to support you. It's just a matter of being very selective, and we'll go into that in a few minutes. In terms of funding rounds, one of the things that has changed from previous years is the size of the rounds. And one of the reasons that this is happening is because it's becoming increasingly harder from companies to navigate from one funding round to the next. And investors want to also have this kind of reassurance that you have enough capital to weather the storm coming. So nobody is ignorant to the fact that we are at a very tricky point in our economies with so much capital being pushed into through various different programs from our governments. So investors want to see you fundraising for a runway of, I would say, 18 to 24 months. That is a lot longer than I have seen it throughout the years. And this is one of the reasons why you will see these funding rounds increasing and increasing. Competition is one of the reasons, but at the very early stages, you will see that seed round has increased by 70% from 2019. So it's not so long ago. It's almost doubling. Series A now is across the sort of space at 8.5 million. And of course, Series B is exceeding 20 million. So companies are raising substantial amount of money compared to previous years to do a few things. First is build resilience, have a lot of capital for the sort of 18-24 months runway. Second is to enable that they reach their growth targets. And even at the very early stages, commercial traction becomes one of the most important differentiators that investors are using, especially at Series A and Series B. So getting from, I would say, a few 100,000, which you will probably have at a seed round, to close to 2 million of revenue at Series A, it requires quite a lot of capital. So if I want to put this in perspective, the journey of a company in Central and Eastern Europe, based on the sort of averages, will be somewhere around these lines. So usually companies will be raising kind of a pre-seed round. In Central and Eastern Europe is somewhere around kind of 300,000 if I look at all the transactions from last year. This will enable companies to kind of build the minimum viable product, go out there and do some testing. It's a lot cheaper to do commercial testings in markets that are relatively easier and less competition is present, as it will be in the US or Western Europe. So naturally, companies in Central and Eastern Europe have an advantage that with very little capital, even at the early stages, they have quite a lot more traction than their counterparts, let's say in the UK or in Germany. So from pre-seed, the companies move on to pretty much launched first version into the market. Obviously, the product development continues. And when it comes to seed rounds, I think that we're definitely heading to a point where seed is getting a little bit larger, depending on the country. So I would say that it's somewhere between kind of 500,000 and 1.5 million, depending on where you are. Obviously, there will be ecosystems like Austria and of course Poland that valuations have gone up quite a bit. So depending on where you find yourself, that may be that may be a bit different. Um, and finally, Series A. I know that this is of course dependent again on the country, but if I look at the whole of Central and Eastern Europe, the Series A is just a little bit behind Western Europe, so around kind of 6 million. Even in CEE, you will find that valuations and rounds are increasing, and I have try to put together for you some benchmarks so that you can understand a little bit about how you can start to evaluate how your company can be valued even at the earliest stages. I know it can be very confusing for companies, especially when the data is so kind of spread out through various different systems. So in terms of seed, which is the sort of upper part of the slide, I have presented it as like a distribution. So imagine all the valuations in the market from the highest to the lowest. The bottom 25 percentile, you will see that even for seed is increasing, is now 2.5 million. So these are the sort of lowest valuations across the region. The median is surprisingly it's just over 6.4 million. So it's increasing. It didn't used to be that large. It's only in the last 2-3 years that we've seen quite a lot of funds in the region, and of course a lot of competition. So naturally valuations are going up. So if you were considering, where do I start thinking about my first round with a venture capital fund at the early stages, and I'm raising a seed round, so maybe the million figure, then that is pretty much where the sort of medium of the distribution converges. And in this particular case, it's really, you could say that it's more like an average. So even in Eastern Europe, we're finding quite a lot of quite a trend upwards. And then I look at the sort of top 25 percentile of all the transactions, and the valuation is in excess of 9 million. So it gives you a sense that even in the region where you find yourself, with the funds addressing that market, it is becoming very, very competitive, and thus funding rounds and valuations are also on a trend upwards. At Series A, this is of course a little bit more tangible. So you will see that the sort of minimum valuations, the sort of bottom 25 percentile will be kind of 10 million. The medium will be around kind of 13, 14 million. And of course, the sort of top of our distribution will be raising at a valuation in excess of 20 million. This is a little bit diverging from Series A in Western Europe, where at the top of the distribution, companies are raising with valuation in excess of 40 million right now. So just giving you a sort of perception, things are getting a lot better. It's becoming a lot more competitive, and definitely a lot more capital is coming into the region. But at Series A is where you are probably the valuations are half of what they are in Eastern Europe. And of course, they will be well behind US market. So this is giving you a sort of benchmark, so you understand as you're preparing for those discussions where potentially you can position yourself. As we all know, valuation at early stages is often very difficult to ascertain. So it's all about your ability to negotiate a very good deal for yourself. in line with where the market is at that moment in time. Um, Great. In terms of funding pathway, I think every founder has to ask themselves, what do I need? Why do I need this particular capital at this stage? And based on why you need that capital, you have to figure out what is the most suitable type of investor. And I will explain on the next slide the various different sources of capital and how very tricky it can be if you're not you're not investing a little bit of research into this exercise. So I'm going to start with conception, which is really the equivalent of your kind of pre-seed. You're very much focusing on technology. So vast majority of the capital that you're going to be raising at this part of the journey, it's really for the technology, the product. Maybe you're going to have a first hire or maybe not. But either way, you're trying to do this sort of feasibility of the market, understand how to fundraise the next round. But vast majority is around the sort of technology or solution that you're developing and trying to bring it to the market. Because the next phase is the rollout. And this is really when companies will be raising their seed round. Because here the focus, while it still continues to be on the product and the technology, it starts to shift very, very dramatically towards the market and proving that early traction. Vast majority of companies raising seed rounds already have a few $100,000 of revenue. In the UK, the average revenue for companies raising seed is in excess of £500,000 or $700,000. So it's becoming often the differentiator for companies. So do not forget the commercial elements of bringing a solution to the market. The technology itself, clearly, as we're in this ecosystem, might not necessarily be the most amazing thing that you could present to the investor. I do realize that there are companies in deep tech and companies in life sciences and healthcare that require a lot of research and a lot of incubation, but that is not necessarily this would be exceptions rather than the rule. The rule is, and looking at the vast majority of companies that can commercialize, then the expectation will be for you to have early traction. And here is where vast majority of companies after seed round will be in a position to determine that their product market fit. So they will have almost a formulaic approach to understanding how they are bringing the product to their client or user, how much it costs them, and most importantly, what is the lifetime value? What is the economic value that I derive from having that user or that client or that customer? And when companies get to this point where it's predictable, is sustained at that level, that is the perfect time to raise your Series A. Because Series A, and usually the scale phase of your company, is going to be all around monetization. And monetization means that if I know how to sell and I know how much it costs me, so let's say I spend $10 for every user, and every user is providing me with a lifetime value of $120, then the only thing that I really need is money. So how much can I scale using $1 million or 2 or 3 or 5 million of capital that I can push into this? And this is why Series A is going to be very different than a seed round. Seed round, you don't have that certainty, you don't have that sustainability. At Series A, it's all about scale. It's all about the execution of your business plan or your commercial plan, of course. And this is where, of course, talent becomes an important element, because your Series A companies go from just a few people to 50 people in the space of kind of 18 months on average. So you're going to be looking for the best talent in the market, and you're going to be growing very, very quickly. And expansion naturally comes after you would have gone through kind of Series B and C. And this is still continues to be about execution, but it's increasingly more about competition, whether you're going to acquire them or simply beat them, or increasing your market size, because the next phase is where if you do those things very well, you're going to be looking either to be acquired or to potentially list. And we would have seen in Romania, of course, success stories like UiPath, where naturally the product was so robust and the growth was absolutely incredible, and they decided to go for an IPO. But that is not just the only way. You can have a merger. You could be acquired by private equity, and I will discuss about private equity ahead of this next slide, because many companies are a little bit confused over, and this is just purely my observation, between venture capital and private equity. Venture capital usually has the few unique characteristics. Venture capital will take minority stakes in companies. They're there to ensure, of course, that you're delivering on your plan and yet you're growing, but they're not going to change management. They're not going to have 50% plus stakes in the company. It will be unusual to see that, even at the later stages as Series B and C's and D's, and I'll show you in a second the data on ownership across stages. Private equity is like a older sister of venture capital. Right now, it has about $10 trillion sitting in funds. In venture capital, we have maybe 500 billion globally. And private equity is particularly well known for taking control of companies. So private equity is really more of an exit rather than a way of funding. Although it's slightly more creative and sophisticated than venture capital ever will be. So from that perspective, private equity is really only relevant at the very later stages of your growth stories. And the purpose for them making investments at Series A and B's is really to secure their interest later on. But now coming back to how companies are funded across their life cycle, and just imagine this, yellow line as the life cycle of a company from day one until your very exit. And at the very early stages, as you're, bringing the technology to the market, there are naturally a few sources that are more relevant than others. Venture capital doesn't necessarily come to build your MVP. It's very rare. So here is where you have angel capital. So these are private individuals backing you. You have, of course, crowdfunding, which we have seen quite a number of companies from Eastern Europe have used it, as platforms like Crowdcube and Seedrs have expanded. Incubators and accelerators are again a source of capital. We have seen very recently university and endowment funds from universities backing innovation. And of course, governments all around the world, and of course the European Commission has introduced quite a number of grant funding for companies in the innovation. So I think right now it's about kind of 9 billion over the next few years. So there's so much capital out there, even at the early stages. But once you do have a product and you do have traction, venture capital becomes relevant for quite a lot of your journey. So just imagine that from kind of seed to all the way to kind of Series D, venture capital is very much relevant. So the journey from a few 100,000 of revenue to potentially, over 100 million of revenue, that is roughly the bracket that venture capital supports. There are other types of capital sources that you will find, and they're definitely worth considering because they could be very relevant for you. I will pick on a few of them. Corporate venture capital, they're really entities or corporations, very large corporations, that have set up either their own funds or they're investing off their balance sheet. So they don't have a different entity, they're investing from their profits. So they are they have been particularly active over the last few years, and many of these corporations where there is a very good strategic fit, they're starting to deploy their capital very early. But definitely having an internal sponsor and understanding those organizations is a precursor of you taking any investment, because the process itself can be completely different. The other element that I wanted to kind of point to is venture debt. And venture debt is a product that complements equity rounds, and usually gives you an ability to have another 30% of capital. It's being used for decades in the US, and it's rapidly becoming an important element in our European market as the pressure to deliver better results increases for founding teams. I told you that I will detail a little bit about dilution. So this is really, on average, what is the expectation of dilution? So this is really the ownership that you're going to be expected to give at each stage, each round. At seed, usually it oscillates between 20 and 25%. At Series A, which is the highest, and it always has been the highest, is between kind of 25 and 30%. And as you move from one stage to the next, you will see that it continuously decreases. So venture capital definitely is a minority stakeholder in companies. They don't take control of the company. And this is really kind of the normal picture wherever you are in Europe, and of course in the US as well. I told you that I will explain where debt fits into this story, and I will contextualize it a little bit. Companies have a lot of pressure nowadays, more than before, to deliver specific growth targets. And while you're able to raise a lot more capital, equity capital, it's clear that even that is not enough. And I will just detail the journey that I would say not even a top tier portfolio company will go through, but the sort of expectation for a company at every single stage. So at seed round, the expectation is that you will have maybe $500,000 of revenue. And in vast majority of times, whether you're in the sort of UK or Western Europe, or whether you're in Central and Eastern Europe, you will only have an ability to raise only a few $100,000 of capital. So it's becoming often very difficult for founders to navigate from seed to Series A and Series B smoothly with just equity elements. Although they're raising a lot more than they have before, the competition and the salaries are going up, the cost of advertising is going up. So naturally, there are quite a number of products that have been designed for technology company by investment funds, often venture capital funds, that are meant to help you along the journey. And at the end of your journey, when you do end up selling the company, the various different studies show that actually you are going to be using 50% equity and 50% debt to get there. So I will just pinpoint to the first part of the journey. Let's take this SaaS company. They're doing their pre-seed. They're maybe raising $500,000. They're building the product, but all of a sudden they realize that, I have a product, but I have no revenue, and I only have a few tens of thousands to push into this marketing, the marketing of this product. So very often companies are, resort more so in the US on acquisition finance. And this is really revenue-based finance, which starts to be deployed at the very earliest of stages, I would say pre-seed, seed stage. which basically gives you capital boost to go out there and acquire your users. You would have seen companies like Uncapped that are naturally positioned for this. The US market is multi-billion right now, but here in Europe, we're just starting to see the very few first of these funds, and I will be managing one of them very soon. And this is exactly the point. You are already expected to deliver quite a lot of revenue by the point you reach seed round, but where is that capital coming from? Because it's clear that you can't raise equity without having a boost on your revenues. So naturally, this is a product that addresses a very neglected part of our market and of your journey. And as you're moving into Series A, you're expected to go with like 1.5 million of capital to about 2 million of revenue in record time. So usually less than a year and a half. And it's often very difficult for you guys to do that. So this is where potentially venture debt becomes increasingly important. Venture debt can be anything from 1 or 2 million, maybe with your Series A, all the way to kind of 20, 30, 50 million in your Series Cs and Ds. So naturally, it's a very important product for you to understand right now, because it enables you to very smoothly get from one point to the next. And you will have seen quite a number of companies from all around Europe announcing Series Bs of 50, 60 million, Series Cs of 80, 90, 100 million. And one of the things that I just want to make you aware is that not all of that is equity. A vast majority of those companies will have quite a substantial element of venture debt or debt built in. And it's becoming something that growth investors are working very, very closely with various different organizations in the space. So I will definitely make you aware, because there will be situations where you have to have the whole toolkit at your disposal to grow your company. Equity alone is not going to be the only thing, and it's not going to put you in the sort of top tier of the companies in your vertical with your type of product across Europe and of course across the US. So don't forget, guys, the US market is substantially more developed. Instead of a handful of providers of such solutions like venture debt or revenue-based finance, I think there may be 30 across Europe. US has hundreds and tens of billions. So this is why companies are able to get to absolutely amazing results in the US, because they have a completely different type of toolkits. And now that you have an understanding that, it's a lot more than just equity, we're going to come back to equity, because before you're going to do anything, equity is an integral part of your journey. And I just want to share with you the mindset of the investor, because often there is this sort of misunderstanding that people working in venture capital, they deploy their own money. That is not true. It's very, very often certainly not the case. But so we'll start with the beginning, kind of myth busting. Vast majority of people working in venture capital are professionals that are managing institutional capital, like British Business Bank, European Investment Bank, EBRD, which for the life of me, I forget what it stands for. And of course, a number of corporations like insurance companies, investment banks, and many different types of organizations. And the unique element is that they have a very high risk tolerance. So it means that they're very comfortable with having a lot of losses in their portfolios, but they're expecting substantial amount of return. Usually the life cycle of a fund, so any venture capital fund will have around kind of 10 years from the moment that they start deploying the capital to the moment that they have to return that capital and obviously the profits to their own investors. So often you will find discussions around how quickly you can scale a company in the next 5 to 7 years. That is why, because the fund itself has to realize its returns in about 10 years. So you have around 5 to 7 years, very traditionally, to realize the journey from 0 to maybe 100 million of revenue, which is often the case, where you can be valued at a $1 billion plus. That is the journey of every single company that wants to be successful. If you can't figure out how to get to 100 million by kind of year 5 to 7, then that is a problem, or you don't have a market that is big enough. So this is a process where these professionals are trying to identify portfolio winners. And why do they look for such incredible growth stories and journeys? Because vast majority of early stage portfolios, about 90% of them, will fail to some degree. And failure in this space doesn't mean that the company has not exited, but it hasn't returned enough capital to the fund to justify or to cover the other losses. So if venture capital makes a return of maybe 1 to 3 times their money, is probably a very bad, poor return. So the reason for this high expectation is because every single company going into a portfolio has to be able to recover the whole fund. So the expectation for you is to prove to the investor that you, first of all, understand your market, understand how big this business can be, and can definitely take it to the point where you are, maybe reaching the sort of 100 million of revenue, and doing that in 5 to 7 years, which by any means is not going to be the easiest things to do. So probably the hardest 7 years of your life. The other elements that are definitely worth considering. Venture capital are active investors, and often the decisions are complex and subjective around the set of skills that the investment team has. And this is something that you will find over and over again. And this is why I encourage everyone to curate the number of the investors and to ascertain whether they have an appetite of investing in the type of technology that you're building or the type of vertical that you're addressing. There are reasons why investors come into a company, and there are some specific rights and some protections that they will put in place just to ensure that obviously they're able to control their own interest. This is something that you should be expecting. It's often a very important element of your conversations with investors. I'm going to start with a very logical, you all know it, vast majority of investors really want to invest in you because they want dividends if you're going to be very cash rich. I have several companies in my current portfolio that are making kind of 40 million of profit a year. They're probably not going to sell for a few years, but they're distributing the dividends. That is not unheard of. It happens. If you're very lucky, then definitely that is one of the reasons why investors are coming into you. And of course, if you're making an exit, the investor wants their fair share. So this is why they will back you at the very early stages, so that when years later, when you are making a billion or two or 10 billion exit, they are able to recover their pro rata. So that is, often you understand why that is the case. Very, very rare that investors will depart midway through the journey. In a secondary sale, it would be, a very, very weird scenario where that would happen. There are some rights that actually you should be aware of. I will point on the control rights section, anti-dilution. And this is something that you guys should be aware of. Obviously, every ecosystem is more is different than another, and I expect that every single one of you guys are going to go out there and probably find investors that have a more predatory approach. Anti-dilution is perhaps the worst things that you could do to a company. Basically, it says that, let's say if I buy 10% in your company, I will forever have 10% of your company, even if you raise 10 different rounds after me. And this means that everybody else dilutes and you issue me free shares every single time you raise capital. Often it's very hard to renegotiate those type of deals. It can be disruptive, and venture capitals down the line might not necessarily like this, and they might avoid, especially if the situation is a bit contentious. So definitely be aware of this. Flag it. Anything that looks like an anti-dilution. Speak with a lawyer. Speak with advisors, just to understand the impact of it. The second most important on this slide is, of course, the liquidity preference. Every single company after Series A will have liquidity preferences. What does it mean? Liquidity preferences, let's say I invest 1 million at 3 times liquidity preference. So in a case of an exit, let's say you exit for 100 million, the first 3 million will go straight to me. And then let's say I have 10% interest in your company. Then another 10% of the 97 million remaining will go to me. There's a difference between me just having 10% in your company, because if I have 10% out of 100 million, it's 10 million. But now think about it this way. If I have a liquidity preference, I'm taking a lot more money off the table. So I have 9.7 million plus the 3 million, my liquidity preference. So always be aware, from Series A onwards, you cannot avoid it. It's going to happen in every single round. If you see it very early on, definitely seek advice, understand how it operates. I'm going to move on to the investment appraisal. And I know you guys will have seen this. Vast majority of time, you have a few meetings with the investors. It goes really well. And then all of a sudden, you go into due diligence. And these are very kind of in-depth sessions that you have with your investors, where you're gonna look at go-to-market, financial projections. They're gonna probably want to know and speak with some of your clients or users or customers. Often you're gonna be surprised by the fact that they will want demos or an expert to give them an opinion on the technology that you build. They're going to probably do their own technology reviews. So always be prepared for a lot of scrutiny, and definitely ensure that for everything that you do and everything that is in your plan, there's a substantial exercise that you can go through with the investor. It's basically justifying, why do you want to build the business in this way and not the other? How did you reach those conclusions, not the others? Why are you building the architecture of your system that way and not the other way? Why are you integrating with that system and not the others? So it's always ensuring that you have that documentation, that you're able to present this to the investor and work through the investment due diligence process with them. Stage 2 of this process is usually done by the investors. They will do a lot of research on you. They will look at your background. They will look at your ability to deliver this. They will verify all the documentation, so they will have lawyers. In some cases, they will do their own market research or ask for an independent validation. And they will definitely do a financial appraisal. And at the end of this, all of the information, if they're still excited about your company, they will write an investment committee paper. And this paper will enable them to go to their investment committee and get the approval, and of course issue you your term sheet. which basically states, how much they're investing, the valuation, the rights that they want to keep in the company. And from then on, it's just kind of a legal process of signing the contracts. So if you're interested in a decision-making formula, is really, really simple. On the technology, you have to be able to present your product, present your technical expertise, present the strategic alignment. So this is really the sort of client or user that you're selling, whether you need integration, whether you're a middleware or otherwise, your readiness level for the technology. On the market size, you have to definitely be able to prove your addressable market, your traction, and definitely articulate very well your business model, and have do quite a lot of research underneath to justify why you do the things the way you do, especially if you're disrupting a specific market. Why will this work better? And on the management side, I know you would have heard that it's all about the people, but I think it's really about two things. It's the perceived ability to execute your plan. So don't be shy. Definitely put the companies that you work with, definitely, it's not about embellishing, but it's being very realistic. These people have to trust you with their capital and their careers, to deliver something that might not have been delivered before. So definitely be very clear of the people, the advisors, the expertise that you bring to the table to scale and execute this plan. How, ensuring that you have all the skills that you require to build a growth business. And of course, your track record. If you have built businesses before, if you have had executive positions where you naturally deliver quite a lot, that is very, very important. And of course, if you have been backed by venture capital and had an exit, then you should have no problem. But definitely don't forget that this is not an exercise in modesty. This is an exercise in you being able to represent yourself in the best light, because this is definitely an important exercise. I know we have only a few more minutes, so I will just kind of focus on the few factors that will influence decisions. And this is something that you definitely have to be aware of when you're doing your research on venture capital teams. Definitely look at their expertise. Is there anyone in the team that has been in that space, that has worked with that technology? Have they invested in something that is even remotely similar to this? Definitely, do a little bit about a bit of research on whether they can invest in your country or in a corporate structure that let's say that you are in Central and Eastern Europe and you want to be invested by let's say Cherry Ventures. Can they invest in a Romanian company? I think it's very important for you to do a bit of, actually ask some questions initially. If you're not aware, do a bit of research. Can this fund invest in my company, in my region? Or do I have to change my corporate structure? Do understand how they work with their companies. Over the years, I have done a lot of meet the investor sessions with my portfolios, whether in investment or at SVB, just to kind of detail the fact that there are some investors that are going to be very light touch. So they're just going to expect you to go with it and just control what you're doing, take kind of a pulse every now and again. And there's some other investors that can offer you quite a lot of support along the way. That may be a way of differentiating between them. And of course, portfolio composition, definitely ensure, have they invested in a company that is doing pretty much what you're doing or your competitor? The likelihood is that if they have, they're not going to back you. They're going to try to protect their interest. And of course, it might be even risky for you, especially if you have something that is proprietary. So definitely be very mindful of this. I have added a few more resources, top investors from the US, and a few links to resources as you're doing your research. So definitely reach out whenever you have any questions. Add me on LinkedIn. There will be quite a bit of details that you can access on the presentation. And I know we have just a few more minutes for Q&A. Okay. I can see here in, have we recorded this, Christian? We can't hear you.
I was saying, can you repeat? Sorry,
So we haven't recorded the session, have we?
No, we didn't.
Oh, okay. So the question for Christian was, no, we have not recorded it, but I do have other workshops recorded on YouTube. So if
No,
you...
the thing with the recording is that I have a library of recordings, and I never have time to go back to listen to them.
Yeah.
So, counting or kind of going on this story, we think it's important to participate. That's why we try to leave also a lot of to make it very we have a lot of free slots during the day, so where you could also participate and also go through your things, and to make it very agile and easy to participate.
Yeah.
But to participate, because it's a lot of